resident income tax with some other various taxes there. So we get a total income, these are from the budget that I gave in February, of around about 1.2 billion. And our outgoings are, again, about 1.2 billion at the moment. So predominantly, they're on public services. So we've got health and social care at 329 million. Now, yesterday, there was lots of conversations about how much we need to spend to correct some of the historical underfunding of healthcare. But that gives you a perspective in terms of we're using about a quarter of our total income on health and social care. And that desire for more money grows each year far faster than inflation because of medical innovation, because we can do more things to more people to keep them healthy and cure disease. We've then got social security benefits and payments, and again, state pensions are a major part of this, which are twinned with the UK, and we've had conversations already from the UK in terms of the effects of the triple lock and the long-term sustainability of our national insurance fund and pension system here. And then we've got education, sport and culture coming out with 133 million. Executive agencies and statutory boards include people like the Post Office, Managed Utilities, the FSA, the Public Sector Pension Authority, the Gambling Supervision Authority. Then we've got infrastructure, and then some of the really important departments, which in the great scheme of things, don't take a huge amount of money, but create a real difference. So, for instance, Home Affairs, that's the fire service, that's the constabulary, that's all those things that, as Minister Paul Wilson said, make our island a safe place to live. And that USP is becoming increasingly important when we're attracting people to relocate here. Enterprise, in terms of giving grants, giving funding, doing some of the work that you'll see later on in terms of the agency model, and actually working with business to promote the island on a global scene, but also help the local economy to develop. What we announced in February was a change in the capital budget. I think often people get a little confused between revenue spending and capital spending. We can spend quite a lot of money on things like the new ferry terminal in Liverpool, but that's a one-off cost. It needs to be balanced. It needs to be balanced in terms of our capital budget. But what we have actually in terms of revenue budgets is ongoing costs. So each wage increase we get happens this year, but every year afterwards it gradually grows. So that long-term planning for government expenditure is incredibly important, but has to be balanced very, very carefully. What we used to have was the Pink Book every February showed everything that could come through in terms of the capital programme. We've now completely changed that so that various departments get the right money, the right resources, the encouragement to develop their schemes first. It can then come to a Tynwald vote 4 times during the year. And the idea is that we will get those capital schemes worked up in a much better, more precise way so that they are ready to hit the ground when they're voted on in Tynwald and ready to be delivered so that those promises we give, whether it's through education, whether it's through the Department of Home Affairs with some of the projects they've got in terms of the sexual referrals unit, we can actually provide those when people can see space in the ground when they're announced, rather than wait for a considerable period of time and then wonder whether there is that commitment still. What we've done over the last year also is try to make a lot of the information that we use in our modelling freely available. So if you go on the government website, we've got the economic dashboard. We try to update this as often as possible with live data. So these were the July figures, they've changed now. We now know that UK CPI has come down to 6.7, our own CPI has come down to 5.4%. But we can see on that graph the massive trauma that's happened over the last 18 months in terms of spikes of inflation, particularly driven by energy costs, and there obviously is a relationship with conflicts in Europe there, but also we're increasingly seeing at the moment OPEC, particularly the Saudis and Russia, managing to control the oil price. There are some concerns about that, at the same time as concerns about a slowdown in the Chinese economy. And when we look at the breakdown of CPI, we had that lag, but particularly energy prices went up very quickly. They're beginning to start going down now. And then we had the increase in food and non-alcoholic beverages, which really drove inflation into people's pockets when they were going out for their weekly shops. Road fuel costs have started going down from their peak, but are still vulnerable to some of those global changes. And again, those global changes, although they may happen in Taiwanese Straits, have direct effects with us. We are not immune, we are part of the international community. When we look at the forecasts, this time last year, Goldman Sachs were talking about inflation peaking at 20%. I think trying to have long-term forecasts at the moment is fraught with difficulties. We know the rough trajectory of things, but as I've said, even a small budget statement by a Chancellor for the Exchequer can suddenly spook the markets at the moment. There's a lot of insecurity out there. And so in terms of Treasury trying to forecast what's going to be happening over the next 12 months, even with our best efforts, it still has to have that protection around it of backups in case things go astray. So the forecast is for the RML CPI to start reducing. We've seen that. We hope it will go certainly below 5% by the end of this year, and perhaps lower. And we're looking at long-term inflation rates going back to the usual level of around about 2, perhaps 3% long-term, after the trauma we've had over the last 12 months. Later on today, the Bank of England will be giving their estimation in terms of interest rates. Now, of course, those have affected many households following on from high inflation. Then those households with mortgages have been hit by sudden changes from historically low interest rates back to what people used to experience in the 70s, 80s and early 90s. Now that has a knock-on effect obviously in terms of expenditure in the local economy, but also we know that on the Isle of Man, proportionately more people own their own home without mortgages. More people also have savings. So actually people with savings in bank or building society accounts are now getting a return on that, probably for the first time in a decade. But when we're looking at intergenerational fairness, actually getting on the housing ladder is becoming increasingly difficult as the proportion of your wages you need to afford a mortgage has increased. And we're working with some of the banks and lenders on the island to understand that and make sure through various schemes on first-time buyers and by working with developers that you'll hear later, we can make good quality housing both accessible and affordable on the rental market and also on the buyer's market. So going on to reserves, we've now had 3 years of rainy days. With COVID and then with the war in Ukraine, massive increases in terms of inflation, increases in terms of the cost of living, and government yet again stepping in to support people, particularly those vulnerable to those increases, and to support the local community through a whole range of schemes. And that has come at a cost. Our reserves are still healthy. Through the Treasury Act, I have to deliver a balanced budget. And so our reserves are 1.87 billion, and those are updated in real terms on the economic dashboard. But what we've made quite clear is to grow the economy, to put the money into the economic strategy, to return to a balanced budget, we will need to draw down on those reserves. In February's budget, I announced that we were going to bring out 152 million from reserves this year, and we're on track for doing that. I'd like it to be less, but we're on track for drawing that down, and then reducing that drawdown on reserves over the 5 years of this medium-term financial plan, so that we're back to a balanced budget. And that's incredibly important, because as I said, we are custodians of the public purse. We have, when you take out the National Insurance Fund, around about £600 million of available investments that we can draw down. So we're talking about, if we don't start topping up reserves, using about half of that for the next 5 years. That reduces investment income, quite obviously, but also means that my successors will have less resources to draw upon if we get another black swan event. We've talked also about the capital programme and managing to put money into the economy through what we build as government and what we commission. But also you'll hear later on in terms of using some of the parts of the Economic Strategy Fund to leverage private investment as well. We want to work right across the construction field in terms of building new residential properties, opportunities for office development, and opportunities for mixed development, including hospitality, that we can do with the private sector rather than government building it all together, and use some of the expertise from the private sector to make sure that's both sustainable and affordable. The challenges we face in Treasury are the same challenges that anyone would face as a homeowner or a company. We've got inflation, we've got general cost increases, and also pay awards. We've gone through a period of very low inflation and fairly stagnant wages. Now, when we look at the last earnings survey, they had gone up slightly to a median of £671 a week, but they've still lagged behind perhaps the historical increase in cost of living. And people are impatient, people are asking for increased wages. We have to respond to those in terms of delivering those services, and again, attracting economically active people to the island. We've got the interest rate increases and the direct effects that has on mortgages and borrowing, but also that's very much a monetary policy from the Bank of England to take money out of the economy. We need to be quite careful that on the island we still get that internal spending in our local economy. As detailed yesterday, and will be detailed again later on, there's a growing gap in terms of the funding of health and social care that needs to be addressed if we are going to adequately give the resources to the NHS to provide what it can and what it should do to our people. Again, in terms of why people should come here, we've got the safety aspect, but also it has to be part of the whole package. People who come here will start families, bring their families over, have to be absolutely confident that their children will get good education, and that if they get ill, they will get high quality health care. But that comes at a cost. It has to be balanced with other priorities. And also in terms of funding the island plan, we have limited sources of funding because of the way our taxation works at the moment. We've got our existing cost pressures, and also we've got the drawdown on reserves to balance as well. One of the things I'm hoping from this conference is challenge, both from you as an audience and from our guest speakers and panelists. We've recently had Moody's coming to see us, and their report was really quite interesting in terms of that external perception of how we're doing, and hopefully you can get some more of that during the course of this morning. They pointed out that our economy is relatively diversified, and that was one of our strengths, particularly over the last 2 years with COVID, that whilst manufacturing, particularly in terms of aerospace, did take a hit, there were other opportunities, there were other ways that people could work, particularly the boom in e-gaming, the boom in the insurance sectors as well. And since the global banking crisis of 2008, we've seen a natural progression away from some of the more standard banking services into other financial services, particularly insurance, but also some of the USPs, some of the other support services for the financial sector, which still remains an incredibly important part of both of GDP, but also in terms of employment and skills in our island. Whilst we're rated the same as the United Kingdom because of our close proximity and because of our ties both through currency and taxation, when you look at the island's growth, it's historically been very resilient. We haven't had some of the booms experienced by other similar small jurisdictions, but similarly, apart from in 2020 during the pandemic, we haven't had some of the busts as well. And that long-term resilience and stability is really important in terms of future investment and confidence in our island. In terms of Treasury's responsibility for our island plan objectives, one part of that is a taxation strategy to be published later on this year. And again, when we're looking at taxation strategies, I'm very keen on doing things incrementally, very slowly, and bringing along everyone affected by those, whether that be individuals in terms of individual tax, or companies and large corporations and large industries in terms of corporation tax. We've already announced that we're working with Jersey, Guernsey and the UK government in terms of the OECD pillars, which bring in a corporation tax worldwide of a minimum of 15% for those large multinational companies. Now that will not affect the majority of companies on the Isle of Man, and we're still really going to pin our taxation strategy to the 0-10, particularly because we know that SMEs are incredibly important to our local economy, both in terms of development, innovation, employment, but also they form the bedrock of a lot of the policies we bring out as government. We're also looking at the investment strategy. As I said, we look after £1.7 billion that's been built up over many decades. And so we're looking now at how we invest that in the best way possible in terms of security for those funds, but also in terms of maximising the return to the Treasury that we can then use to invest in public services. But we've already completed some of the types of cost of living supports that were brought in last year when energy prices went up. Mr. Paul Wilson's already talked about the electricity freeze. We were the first jurisdiction in the British Isles to bring that in, but also the significant financial support we gave right across the piece to try to balance out some of the shocks that people were experiencing through increasing costs. But that support was very much to allow people to adapt and adjust to a new environment when inflation was going to stay higher, when interest rates were going to stay higher, and when the cost of living was going to stay higher. From a government perspective, we cannot continue supporting the local economy in the way we've done over the last three years. It is simply not sustainable to have that dependency on the central government. And what we need to do is work with our population and with our business sector to actually increase the prosperity of the island, reinforce and reinvigorate that resilience in our local economy to get us through whatever else will be thrown at us in the future. We also looked at the National Insurance Review. GAD, the government actuary department in the UK, are asked to come and look at the way our National Insurance Fund operates every 5 years. And they've constantly predicted that if we do nothing, that fund will be worn down and extinguished. Their latest review that we presented earlier on this year shows that time has come forward to 2047. Now that still seems a long way off, but the reality is we have to have a sustainable National Insurance Fund to fund long-term pension payments to our state pensions. If we don't, then we'll have a similar issue that we have with the public sector pensions, where it has to come out of general revenue, and therefore we have to raise more revenue to pay historical commitments. So one of the aspects of the National Insurance Fund is looking at how we can make small changes now to make it sustainable in the long term, going over at least the next century, not just the next couple of decades. And that's a work in progress that we'll be announcing various other work streams for that in next year's budget. So that's the end of my brief presentation today. I don't know how we're doing for time, James, in terms of questions. Have we got some time for questions? Subsequently, thank you very much. Because we sort of built in with this whether we could take questions. What we're going to have next is one of the keynote speeches. We'll then be having panel discussions for questions, and I'll be doing another question and answer session at 12:30 up in the cinema. And as I said right at the onset, and been repeated really throughout this conference, what we want out of this is a dialogue, is a conversation. We want to be able to talk with you about how government works, what our plans are for the future, and what your plans are, and make sure that they resonate. So I hope you enjoy the rest of today. I look forward to speaking to you